Hi, you're listening to Avenue Insights. Any views expressed in this podcast are based on information available at the time and are subject to change without notice.
Okay, so thanks everyone for tuning into this quarter's podcast. Bill and I thought we would take a moment here and go through a few of the key topics that we think were discussed in the quarterly letter that we think everyone would find most interesting. And I guess the biggest thing that we talked about, just to start it off in this letter, was really touching on the inflation debate that is being talked about all throughout the markets and in financial media. But before we get into it, I guess, Bill, I'll throw it to you and have you highlight why inflation is so important from an investor perspective.
Yeah, absolutely. Yeah, as we're coming out of the pandemic right now and the economy's coming back and we still have shortages, we just have this initial spike in inflation. And this is what the quarterly letter, we highlight that as our first topic, and sort of Canadian and US inflation sort of getting up 4 or 5% range. And it looks like a pretty shocking number compared to what we're used to. And then the point here is really why does this matter so much? And actually, inflation sets the tone for the bond market. What is that level of interest rates? And we've gotten used to a very low level of interest rates, in which case, does the bond market have to react to inflation, and are interest rates now going to be significantly higher? Why that's important is because the bond market really underpins, all the asset prices. So the bond market as an asset class, but then here's the level that houses trade at. Here's the level which means that mortgages trade at, which means that hard assets and then inevitably stocks trade at. And this simple thing, what is the market multiple, which has historically been about 15, 16 times earnings, but now we're pushing where the stock market is trading roughly 20 times earnings, which is called the market multiple. And when interest rates are low, you're willing to pay a higher price in the stock market. But now if we're looking at, if inflation is coming back and bonds trade higher, well, will the market multiple be lower? So it really is a central question, and whether it's always in the background, but right now it's just very poignant because we have this inflation. And so now, Bryden, I'll throw it back to you because it's not just the arguments, but you've got some good slides on this. And I think the way in the letter we've tried to pull this apart, which is, yes, we think there's inflation, but ironically in goods inflation, we want to separate what is goods, stuff you buy inflation versus asset price inflation, and sort of tease those two things apart. But I'll throw it back to you and really touch, and you've got some great slides on sort of what is goods inflation and an argument for where we see that type of inflation going.
I think on that topic, I think the most interesting thing when you break out the good side of the inflation piece, and so just as a background, within inflation, there's a component that is goods, and then there's a component that's services. And the last decade, you really had services as the main components that were driving inflation, or at least keeping inflation stable. And we had a decade of goods disinflation, so lower inflation for things like home furnishings or electronics or things that you actually buy that are tangible physical goods. But what was unique about the fiscal support last year, right after the pandemic started, was you had fiscal support basically become income replacement and income supplement in a way that we haven't seen really in a generation. And so it was the first time in a recession we actually had income and spending go up, but it's because there was so much fiscal support from governments in both Canada and the US. And so we were able to sustain consumption last year at a much higher level than we would have based on just ongoing economic activity in 2019. So that in itself is a sort of a fascinating case study about what was unique about the COVID recession. And we've touched on this in recent podcasts. But the other thing then to add on to that is because of all the lockdowns last year, you had significant curtailment of global shipping lanes and supply chains. Asia, Europe, North America, there were issues everywhere in terms of getting goods to that next level of production that then can be created or turned into a consumable good or durable good. And so not only did you have the elevated demand from all this fiscal support, but you also had limited supply because of issues around, social distancing or factories that were shut down, or you're not able to get enough shipping, boats or planes, all of these, cargo issues that are still even working their way out right now. So you had higher consumption that you otherwise would have had, and you had lower supply of goods than you otherwise would have had. So it's driving, sort of eye-popping year-over-year numbers in consumable goods inflation. And that's, really what's driving a lot of the headline inflation numbers right now. The other thing it did is that in the restocking phase, you had, certain parts of the U.S. manufacturing sector just, going very strong to try to meet as much supply as possible, because international goods were not able to go into the North American market as quickly as they would have without the pandemic. So I think a lot of this is going to take time to work itself out. And I think the argument for why inflation can be stickier, and which means it's less likely to go down, is that these supply chains, you can't just turn them off and on. They take time, and it takes time for production to get ramped back up again. And so I think the question for the rest of the year is really, at what pace do we see supply chains start to normalize? And is there supply that can continue to come back online from international production, like let's say in Asia? And I think if so, then it gives you an argument about why the inflation numbers that we're seeing right now are not likely to last. And specifically looking at what the bond market has been doing, is it feels like the bond market is now sniffing out almost peak inflation. And so we'll have to see if that actually happens. The other argument is that if you look at what house prices have done, in Canada and the US, really going off the charts, we're now, a year on where we're probably likely to see rent inflation to a point we haven't seen in a while. And rent inflation is actually the largest component of inflation. So there's an argument now where rent inflation is going to be sticky. So you might have goods inflation come down, but services inflation come back up. So a lot of this is kind of evolving on the go. But I think going back to what you started with, Bill, is really the bond market is taking cues that at this moment, inflation is not going to last at this level, with interest rates now having come down. But that is the goods and services inflation. The whole other side of the argument is.
So maybe I'll touch on one question there, because I know this is going to come up, and
Sure.
And this is what I get asked all the time. So, okay, if the price is up, and then I would frame it in terms of, okay, this is my cost of building my house or building my factory, and it's up. And now that they're so high and I don't have any extra money, well, then I just don't build anything. So this is where you sort of get an economic, your prices are high and there's no extra cash in the system. And you just sort of go, oh, but actually wages are going to go up. So you get this spiral because goods prices go up, but then I got to pay people, more, or and then they force the prices up. And then that was the 1970s cycle of wages and goods inflation. And I think you have some thoughts on where we actually are in terms of the labor wage inflation as we come out of the pandemic.
Yeah, I mean, that's also one of the arguments for this, people are making about why inflation is going to be stickier, because you're now going to have, now that prices are up, that means that companies and businesses are going to have to pay people more to work because the cost of living has gone up. So, and in principle, that is, that makes sense. The other side of that, I think the challenging argument about that is, in a lot of ways, I think, people think of profits as it relates to the stock market as sort of what drives the stock market, but then there's profits in the actual real economy. And, if you look at a lot of the data we follow, you're not seeing a bounce back in profits in the outside economy that's not a public in the public markets. And so the problem now is that if you have businesses or companies that don't even have the profits to be able to raise wages, then the problem is, it's hard to get an argument about how wage inflation is going to be very sticky, because, a great example would be, the restaurant industry that, is short workers right now, and they can't get people back to work. And it's busy right now in the summertime, but, restaurant profit margins are only so high to be able to afford, certain wages. And so I think the next shoe to fall, what would be very interesting to track is, do you have businesses actually have to cut back on either services or production because they actually can't afford to pay higher wages because there's not the profit margins in the economy to actually support that. So that's a, you know, a very stagflationary kind of outcome where prices have gone up, so the cost of living has gone up, but businesses don't actually have the profits to be able to raise wages. So then they actually restrict output. So you're stuck with high prices, but lower economic activity, which is kind of you're getting the worst of both worlds. And so I think, you know, we've talked about this the last couple of weeks just in the office of, you know, there's the theoretical sort of economic history of all of these things. And in a lot of ways, we're really living through sort of a real life economics classroom because we're seeing these things happen in real time in a way that you certainly haven't seen in a generation. And, you know, the other side of the coin is just saying, which is, you know, at this point unknowable, but how long is the added government support going to stay in place? You know, specifically in the US, there's a lot of states that are starting to roll back the extra unemployment benefits, but we might now come in, you know, Democrats might have another massive fiscal package. So is there some kind of income support in that? You know, who knows? In Canada, you know, some of that's being phased out, but, you know, I love the saying, you know, there's nothing more permanent than a, you know, part-time or short-term government program. So a lot of these things probably aren't going away fully. And at the end of the day, with government support at the level it is at, the government is competing with the real economy for labor because people are getting income supplement not to work and are much more hesitant to go back to work. And if the government is sort of, you know, competing with the real economy for labor, it's not really an optimal situation to drive, you know, any kind of real productive economic activity. And so I think what's very interesting about this whole debate is that there's the inflation happening right now, and there's the clear goods inflation and services inflation happening. But then there's the forward-looking 12 months of what is the outlook for both government intervention, what is the outlook for real economic activity, and can the real economy actually support higher wages given that we're in an inflationary environment? And that's, I think, going to be the most fascinating thing to watch.
Yes, so maybe I'll hit that because I'll just summarize that because this is the big debate, you know, just discussion that we've had in the office over the last couple of weeks is that there's two economies. And to summarize what you said, which I think is a fascinating point, is there's a number of high profit margin companies that can certainly push prices through, but there's another whole half of the economy that just doesn't make enough money. There's no profit to suddenly increase everybody's wage. Yeah, I think that's a great point. Okay, so at great personal risk, because we did this in the quarterly letter and just sort of moved from the goods, so that headline CPI inflation, and then move it to our asset inflation, where we still think that it's an extraordinary time with low interest rates, how much you want to pay for something because your borrowing costs are so low. We've always said, maybe I'll even frame this point because this is from a few years ago. When a house is $500,000 and you can say, okay, my interest rates are going to be 6-7%. Well, maybe the house is $100,000 more, maybe it's $100,000 less, depending on market and sentiment in that day, in this point in time. But when a house is $4 million, the extraordinary thing is, are you going to pay 6 or are you going to pay 3? That's a $2 million swing, but you just don't know because interest rates are so low. Somebody may feel on that day to pay $6 million. And so as asset prices go higher, they're also more volatile. And so just to frame that, and so why this we try to explain this, and I don't want to go into too much detail here to get lost in it. But so far, all this government stimulus that you've also repaid to, and it's amazing that it's still ongoing. In Canada, it's still ongoing. And when it stops at some point, there hasn't been money created. This is our point. It's still just been borrowed. We believe there's so much money been borrowed that it's not going to get paid back, but that's not how it works at the point. And what we did in the quarterly letter, again, was try to explain how if it's not printed, it's not really in your hands yet. And it sort of gets stuck in the mechanics of the banking system. The banks aren't lending it out to, here's a company that wants to build a new factory, hire new people, you know, build all the resources. That type of lending is not happening. This trillions of dollars is stuck in the financial system, but it has to go somewhere. And so it goes into financial assets. And when you're looking at the stock market, that is a financial asset. And again, because if historically bond yields were higher, A lot of it would live in the bond market, but then bond markets are so low, and these are the slides I'll let you refer to, Brian, but this is our whole point, is that because interest rates are so low, the money has to live somewhere. And this is extraordinary slides that you put together for the quarterly letter of just showing just how much money is coming into financial assets.
Yeah, I think the chart that we had looked at, I think it's just the inflows into equities is really off the charts. And so I think the number specifically was that current inflows into the US, this is the US equity markets this year so far, are running at a rate higher than the last 20 years combined. So 20 years combined of equity inflows jammed into, now 7 months into the year, if we continue at this pace into the end of the year. And so you can't understate sort of how much money is flowing into equities. And I think a lot of this too is really, it speaks to investors' risk on sentiment. And so if you look at margin debt as well, that's now at record highs. You have a lot of the, retail participation in a way that we haven't seen in a generation. You have auctions activity like we haven't seen ever. You have the crypto thing happening. And so there is this huge speculative environment going on right now. And I think the sort of broader longer term risk that we keep looking at and can't shake is that your economic activity is only supporting so much actual true business value. And then you have the Federal Reserve with low interest rates stimulating people to want to speculate on assets, which then is driving everything up. I mean, the other chart that we added to the quarterly letter that was really, I think, telling is if you look at foreign ownership of US equities, it's off the charts. So you not only have people domestically in the US or in Canada buying domestic equities, you have international investors in Asia, in Middle East, in Europe. All of that money is flowing into US equities, driving things up higher. And so the problem with these environments is that they can continue far longer than you think, and they can continue far longer than is comfortable. But you can't look at, one of the measures we like, you can't look at market cap to GDP in the US and not just, your eyeballs are popping off the page. We're now 30% higher than where it was in 1999. And I think all of these things in hindsight, once we get to whatever, endpoint the market takes and however long it takes, I think in hindsight, how ridiculous this environment is will be very clear. But while you're in it, it's just fascinating how you can see people kind of justify why it can keep going up or why it's fair value or whatever, all these things. But the problem goes back to originally with interest rates really low and people willing to speculate. There's really no limit to how high things can go up, whether it's real estate, whether it's stocks or equities. And I think not to go on a total tangent here, but your comment the other day of just if you look at all these geographies in Canada, these small towns where real estate's up 30 or 40% over 1 year. I mean, that's not supposed to happen. You're not supposed to have assets go up this high, this fast, because it creates a destabilizing effect in the long term, because then you have credit and margin all added on top of these elevated asset prices. And these are where things get very dangerous when you start applying leverage and credit to elevated asset prices in a very speculative environment. So
yeah, it doesn't mean it's coming off either. Like this is the term we used in the quarterly letter was, there's nothing normal about this. Interest rates are it's not to be a conspiracy theorist or anything on this. It's just sort of but interest rates are being artificially suppressed because of central bank activity, and it's going to create other issues in the asset price. We've talked about that for a number of years now, but now you're watching it real time, and you're saying none of this is normal. But I think our phrase we're using is that you better get used to it because this is the new normal. And I would say from your comments, it's not that we're hopping off the train and sitting on the side of the tracks waiting for the next train to come along. We believe you still have to stay in the market, but more than ever, and this is the phrase, it really matters what we own, and it really matters how much we pay for it, because again, there isn't really an alternative. We can't just go and sit it out somewhere, because even though those asset prices are high, it doesn't mean they're coming off.
Yeah.
With our interest rate view, I think I come back, like we can pick our different asset classes. If I throw it back to you, what is our expectation for interest rates as you say, running through that whole, the rundown on goods inflation and asset inflation, what would you say is our 1-2 year expectation for interest rates?
Yeah, I think they're gonna remain low. I think the bigger elephant in the room that is not being addressed at the policy level anywhere, whether it's government or the central bank, the biggest elephant in the room across the board in the world, Canada and the US, government and total debt levels are far too high. And the problem is the economic activity that we're generating now with all of this debt is not able to sustain everything as we're going here without very low interest rates. So the problem is you are in a situation where, because of the large debt trap that we're in, policymakers feel like they need to keep interest rates low, and they feel like they need to keep doing more stimulus to keep the economy going. The problem is you make this system more fragile every time you go. And so there's almost no way out of this but to keep interest rates low. The problem then is you also create wealth inequality because you're driving up asset prices. So then you have people say, well, this is not fair because, look at asset owners who are benefiting where, well, the real economy, isn't benefiting from central bank policy, and which I totally agree with. The problem is, the tough medicine out of this is going to be a level of tough medicine that we haven't seen in a generation. And I don't think politically we're at the point willing to make that decision to want the tough medicine. But I would have the view, I mean, at some point it will come. How long? There's no way of knowing, and we don't try to pretend to know. But it forces investors to really think about what they own and why. And I totally agree with you. You can't sit in cash and not be invested in anything, because this game can continue for a very long time. And so, in a lot of ways, we have the freedom of being unencumbered and not benchmark constrained in what we do. So we can really go in and try to find value in places that other people in the investment industry can't, because they're constrained by, what they're doing. And so we think there's a lot
in the business, in this highlight, just we've talked so far, we've talked about asset classes and saying, and the stock market isn't just one thing. We sort of break down stock market into a number of economic components, but then really bringing it back. And I think always in our strategies, bring it back to that business. And what are those underlying businesses? Are they core to the economy? Can we park our money in this business and have it safe, sort of safeguarded and compounded in this actual structure, instead of saying here we're just exposing ourselves to an asset class called the stock market. We've actually taking our savings and distributing it into really high quality, profitable companies where we can avoid some of the excesses that we actually see.
Yeah, I think the other thing too is there's a lot of, this is a kind of environment where there's a lot of strategies and managers and investors can thrive, but it's really the ones that are willing to acknowledge that we're in a bit of a speculative mania, and you just have to treat it as such. And I think where people run the risk of the greatest danger is just not accepting or acknowledging what's going on and how nothing is normal, as you said. But you still have to play the game, and the game is to keep invested, to allocate capital, to find opportunities, and I think that's really the pathway through for investors. Is you have to accept the game that you're playing, and you just have to adjust as you're going, but really be paying attention to what's going on, because justifying this as everything's normal is just, I think you kind of have your head in the sand.
And I think what we've talked about a lot, and certainly it's in the last 12 months, I would say 6 months, but the last 6 months have gone by so fast. It's just the speed with which things change. And even individual asset classes where we're looking at infrastructure, real estate, when the move comes, it just happens very fast. And stocks can be re-rated in a number of days, or weeks, but it's not something we're finding that themes or trends aren't playing out over 6 months to 9 months. They seem to be playing out in a number of weeks. Once something is established, money moves very, very quickly.
Yeah, I think everything is being accelerated at a faster and faster rate, and I think that is definitely something that I think you can expect to continue. And it's once asset prices have run this far, the volatility the whole way up becomes larger and larger magnitude, and I think it's going to continue to be a very, very unique and interesting environment as we work through not just all of the inflation stuff, but also really on the good side, but also the asset inflation. And we haven't even talked about the Fed, which, we don't have to go too deep into this, but you now have, the Federal Reserve that is now in a very challenging position because you're kind of underwriting this speculative environment, but at the same time, you have to keep interest rates low to make the government debt affordable, and it's almost, you don't even know what they're going to do, really.
Well, I think we'll leave it on that. How about we say that, and in summary, even though we're in this remarkable situation, it's our belief that we still have to stay invested, but more than ever, it matters what we own, what are that underlying core businesses that we have, and then it really matters what you pay for them in terms of to have stability under the portfolio.
I couldn't have said it any better myself. So why don't we wrap it up on that, and then we'll look forward to the next quarterly podcast.
Great.
I hope you enjoyed today's conversation. You can find us on avenueinvestment.com, where you can learn more about the topics discussed today at our blog or subscribe for updates to our content. You can also follow us on YouTube, Apple, Spotify, or wherever you get your podcasts. Thanks for listening, and we'll see you in the next episode.